Hello, everybody, and welcome to the fourth episode of the Multifamily Methods Real Estate Podcast. I'm your host, James Gleeson. Been a good week, pretty busy week. Got some pretty exciting things going on. So the market has been behaving pretty weirdly, and I've been exploring some different financing options. So, for those of you listening who are not super familiar with all of the financing options as it relates to multifamily real estate and apartments, but also residential real estate, 1 to 4 units, that is most of what I'm going to be talking about today. Brief update for me this week. Yesterday, I met with some private equity folks, which was pretty exciting. They started business last year and they're looking for sponsors and investors to invest with and business owners so that they could produce yield for their investors. And so I met with them. There were about four of them yesterday in their office, kind of went over my story, how I got started, and what my goals are. And I think it went quite well. So we will see where that lands. If you're listening to this and you're trying to grow as an investor or as a business owner, I mean, the more people that you get in front of, the more successful you're going to be, period. I've said this over and over again. I am where I am today because of the people that I know and the people who I have relationships with. And this private equity meeting, I might not get anything from it for several years, 3 years, 4 years, 5 years. I'm in a place right now that I really don't care. I don't really have an agenda. I don't care to really get anything. But if the relationship organically turns into something, then that's great. And great relationships take time. So if you're waiting until, you find a deal to build a relationship, or you're waiting until you need money for your next deal to build a relationship, you are going to be disappointed. Because it takes a long time to build trust. It takes a long time to build credibility. And you want to be having those relationships proactively. Relationships can lead to financing, to deal finding, to, subcontractors, vendors, banks, commercial lenders, management, personnel, management companies, if you decide to go that route, real estate agents, people that you might decide to do joint ventures with, so partnerships. And so, relationships is really a key component to building success as a real estate investor and in any business. So what I'm doing today, for those of you who are not familiar kind of with what's going on right now, I'm recording this in June of 2026. We just got Warsh as the Fed chairman. So Jerome Powell is no longer Fed chair. They're going to have their first FOMC meeting next week. The market, so basically during these FOMC meetings, the Fed chair announces, a few things, but primarily what they're going to do with the Fed funds rate. So a lot of people get confused with how mortgage rates correlate with the Fed funds rate. So the Fed funds rate really has a direct correlation with short-term rates. So if the Fed funds rate decreases, this does not have a direct correlation with interest rates, with mortgage interest rates. And a lot of people get this confused. And so what's happening right now in 2026 is that there is a fear of worsening inflation. So the CPI right now is just over 4%, and the Fed's target is 2%. And so inflation is basically double what the central bank, what the Federal Reserve is targeting. And so what the Fed is supposed to do to react to that increase in inflation is increase interest rates. And an increase in interest rates incentivizes savings. It disincentivizes borrowing. And thus there's less investment, there's less credit in the market, and thus in theory there's less inflation. And so first of all, when you hear the government talk about the CPI, that stands for the Consumer Price Index. This is what the government bases this is what the government essentially calls inflation. But if you look at the Webster original definition of inflation, inflation is nothing more or nothing less than an expansion of the money supply. And I would add credit to that as well. So when you think about inflation, you really should be thinking about an expansion of the money supply and an expansion in credit. So whenever you hear the term, printing money, monetary easing, any whatever term the government comes out with to basically print money, that is an expansion of the money supply. So that by definition is inflation. And when you have more dollars in circulation in the market, you a lot of times prices increase. So an increase in prices is not inflation. An expansion of the money supply is inflation. And a lot of times that correlates to increased prices. And that increase in money supply actually hits the market through commercial banks. So when the Fed, quote unquote, prints money, they don't actually print money anymore. It's just, digits, increasing numbers, right? But when the Fed does this, that doesn't automatically create an expansion of the money supply. But when the banks lend that money out into the market, that's what actually creates that expansion in the money supply. And so the CPI is not a reliable source for inflation. I will repeat that. The CPI is not a reliable source for inflation. So if you hear the government talk about the CPI, or you hear in the financial media the CPI, inflation is probably a lot worse than the CPI, because the CPI, by design, decreases reality. The definition of the CPI has changed since the 70s. Now they allow substitutions. So if there's a crazy outlier in the CPI, like let's say the price of broccoli just skyrockets, then, the government can say, well, most people aren't really eating broccoli. Most people are actually eating zucchini. So we're going to replace that CPI data from broccoli to zucchini, and thus that decreases the CPI. And if we have less inflation or less CPI, the government can then decrease interest rates and print money, which is politically a good idea. Everyone loves it when interest rates are low. And when the Fed can just continue to print money to monetize their debt, that is a good thing for the government. And so whenever you see CPI, just know that the inflation rate is actually much higher than that. But getting back to my point with the Fed funds rate. So the market thinks that basically interest rates are going to stay the same next week. And the market pretty much thinks that interest rates are going to stay the same pretty much all year, except for towards the end of the year, they're thinking that there's going to be one interest rate increase, which, obviously Donald Trump won't be happy with. But when you look at mortgage rates are tied to the 10-year Treasury. And the 10-year Treasury is just a market, just like the stock market, just like the precious metals market, the real estate market. You have a bond market. And these are investors, domestically or foreign investors. So you have people in the United States or people in China, for example, who are investing in these bonds. And a bond is essentially loaning money to the government for a rate of return. So you can purchase a 30-year Treasury bill. You could purchase a 5-year bond, a 10-year bond, or a 30-year bond, right? And there's a lot more options than that as well. But essentially, you invest in these bonds, you get a fixed rate of return from the U.S. government, and the government borrows your money. And what happens is, It's supply and demand, just like any other market. So as demand for these bonds increase, the rate for these bonds don't have to be as competitive. So these rates decrease the yield that these bonds return. But as demand for these bonds decrease, the yields of those bonds increase to create more incentive for more investment. And so what you're seeing today is you have a CPI of over 4%. So keep in mind, inflation is probably more like 6, 8%, but the CPI that the market is looking at is 4%. So in order for these bonds to make sense for an everyday American, you need a yield of greater than 4%. Otherwise, if you have a bond that's at 3% and inflation is at 4%, you are losing 1% every single year that you hold on to this bond. So you are losing purchasing power by holding on to these bonds. And so traditionally, historically speaking, what happens when inflation is greater than the yield that bonds are producing, investors sell their bonds and deploy their capital elsewhere, typically precious metals, like gold, to hedge against inflation. And so even though, even if the Fed funds rate decreases under Warsh, it's really determinant on the 10-year treasury what happens to mortgage rates. And so if inflation continues to get worse, and if the people are selling their bonds because they're not getting a real return from those bonds because inflation keeps increasing, then people are going to sell those bonds and the yield of those bonds are going to increase. So even if you have a decrease in the Fed funds rate, there might be an even greater fear of inflation because of this decrease in the Fed funds rate, and we might actually see an increase in inflation. And as we see an increase in inflation, you are going to have an increase in mortgage rates. And so this is one of the scariest realities for real estate investors and for the economy today. Most people think if the Fed funds rate comes down, mortgage rates come down, and vice versa. It does not work that way. And in fact, a big risk for our economy right now is what's known as stagflation. And we technically are already in a stagflationary environment, but that's essentially when inflation gets worse and asset prices decrease. This is like the worst of both worlds, right? And that is exactly what can happen here if inflation continues to get worse, people continue to sell their bonds, interest rates increase, and the economy goes to the pooper. Obviously, the real estate market would do horribly if interest rates continue to increase. The stock market, every single market, the bond market, every market that you can imagine will get worse as interest rates increase. And so that is a huge risk. So if you're listening to this and you are a real estate investor, there is, I don't have a crystal ball. I could be totally wrong about all of this. Some of the smartest economists in the world tried to predict these things, and they are wrong all the time. But it's good that you have this information and you understand how these things work so that you can try to set your ducks in a row. But a big risk for real estate investors right now is that mortgage rates are probably going to continue to increase as inflation probably continues to get worse. How do I know that inflation will probably continue to get worse? Well, the government continues to print money. They are doing quantitative easing right now, even though I said monetary easing early in the podcast. It's quantitative easing. The Fed is doing quantitative easing right now as we speak, even though they're not admitting to it. And so they're expanding that money supply. The fiscal policies right now, there's no cut in government spending. And so, we're printing money, we're spending more money, the government's spending more money. That is what creates inflation. And so if we look at this objectively, regardless of what financial media tells us, regardless of what Warsh tells us, or, the Fed, we can be confident that inflation will continue to increase as the money supply continues to expand. And so We are pretty confident inflation will continue to get worse. And so, as an investor, interest rates will probably continue to increase. And that's not good as a real estate investor. Now, that's on the residential side. If you're buying 1 to 4 units and you're getting, conventional financing, those are the interest rates that I'm talking about. Now, there's a whole nother world of financing that is commercial lending. And commercial banks, most of the time, their interest rates are tied to prime. And prime is tied directly to the Fed funds rate. So you kind of have two completely different real estate markets that are working here. So if Warsh decreases the Fed funds rate, then that actually has a direct correlation with commercial banks decreasing their interest rates. And so in the multifamily apartment world, you really have two areas that the vast majority of your investors are in. You have what's called agency debt, and you have what's called just commercial debt, commercial financing. Commercial debt, if you're an apartment investor, this is some of the best financing that you can get, probably besides HUD financing. But agency debt is some of the best financing that you can possibly get for multifamily real estate. You get a 30-year amortization, which means a 30-year term, whereas with commercial, you only get 20 years. At most, you would get 25 years. You get a 10-year fixed rate debt. With commercial loans, you typically only get a 5-year, and it's an ARM, it's an adjustable rate mortgage. So you get 10-year fixed rate debt, you get a 30-year amortization. There's also options for interest-only periods. So an agency loan with Fannie or Freddie might look something like 10-year note amortized over 30 years with interest only, IO, for 5 years. And that obviously increases your cash flow. Okay, so the agency debt is great debt because you get fixed rate debt. It's more predictable. The amortizations are long, so you could get higher cash flow. You get interest only periods, so that also can correlate to higher cash flow. Interest only has some pros and cons. Obviously, you're not paying any principal, but for the short term, you are getting more cash flow. So if it's an asset that you don't really plan on paying off, that could be a good option for you. If it is an asset that you do want to pay off, you probably don't want to do any interest only. You want to try to shorten that amortization and pay it off more quickly. But that agency debt is tied directly to the bond market, similar to mortgage rates. So kind of that dynamic that I was talking about where bond yields are actually increasing. That is why you see a lot of apartment investors struggling right now. And even if they're in the future, if there are talks about Warsh decreasing the Fed funds rate, you are still going to have this problem in the bond market where yields are increasing and apartment investors who have agency debt are going to struggle. Okay? Now on the other side, you have commercial financing. This is typically 20-year amortizations, 5-year loans. So you get, the payment is such that it is a 20-year note, but the interest rate is only fixed for 5 years. After those 5 years, if you have an ARM, an adjustable rate mortgage, that rate will adjust after 5 years. If you have a balloon, that note will be due in full at the end of those 5 years, and so you need to sell or refinance. So by the way, if you have the option between an ARM or a balloon, go with the ARM. But that commercial financing, again, is tied most of the time to prime, which is tied directly to the Fed funds rate. So if you are an investor who has commercial debt, you will benefit from a decrease in the Fed funds rate. Now, will that happen? Unfortunately, the talks for 2026 is that either nothing happens or interest rates increase. However, Donald Trump is obviously, he put a ton of pressure on Jerome Powell. He's not doing the same thing with Warsh right now, but he most likely eventually will. And so, also the Fed is kind of in between a rock and a hard place. You have inflation getting worse, But you've also had the risk of unemployment getting worse, which would cause, a decrease in GDP, luckily a recession. And so obviously the Fed does not want a recession. That is not good politically, but they also don't want an increase in inflation. So if they decrease interest rates, the risk of recession decreases, but the risk of inflation increases. If they increase interest rates, the risk of inflation decreases, but the risk of recession increases. So they're in between a rock and a hard place. I think if they're put in between those two hard places, if you have to choose between, the economy completely collapsing or inflation getting worse, they are going to choose inflation getting worse, in my opinion, and in a lot of experts' opinions. So they're not just going to allow, an '08 recession or a 1930s depression and just put their hands back and say, well, there's nothing we can do about this. Most likely they will intervene. They will decrease interest rates. So I still think that the Fed will ultimately decrease interest rates. They also have to, as the Fed funds rate increases, as the yield on bonds increase, the Fed has to pay more money, or excuse me, the government has to pay more money on their bonds. And so obviously politically and for the fiscally and for the government, that is not a good long-term solution because our country will go broke because we're in $39 trillion worth of debt, probably going to be 40 trillion pretty soon. And so if those yields continue to increase, the government simply would not be able to afford paying its bond debts without more quantitative easing and printing and things like that. And so with those two decisions, the Fed will likely decrease interest rates, but we will see. No one knows for sure. And so if you have commercial debt and the Fed does decrease interest rates, then you will benefit from that. And so for me right now, I am more bullish on commercial debt than I am agency debt because there's, in my opinion, a higher likelihood that those interest rates decrease. And so what I'm doing right now is I am trying to get my debt in the best financing terms that I possibly can. Prime right now is 6.75%. So I have some loans that are in the mid sevens still from a few years ago when rates were higher. And so I'm trying to move those to prime. And I have a lot of loans right now that are in prime floating, which means as the Fed funds rate and thus prime increases or decreases, my loans will also increase or decrease. And so I still think rates are going to go down. And so if rates go down, my prime floating rates will also decrease. And then whenever I think that that's going to turn around for whatever reason, I could lock in that rate and hold that rate. So that's what I'm doing right now. If you have any apartment deals or multifamily deals, I am a bigger fan of the commercial financing right now. Go to as many banks as you possibly can. Dan Pena says that you are 100 cold calls away from being a millionaire. That is factual. If one bank says no to you, call the next bank. If you're listening to this and you're in residential financing, same concept applies with DSCR lenders, commercial lenders, conventional lenders. Shop around, see where you can get the best financing. Try to lock in your term for as long as possible. Some commercial banks will give you 10-year financing. I would take a 30-year fixed rate loan over anything right now, hands down. So if you could get access to that, do so. And make sure that you're keeping your eye on the market. In real estate, we hear about it's not about timing the market, it is time in the market. And this is true. The longer that you hold on to your real estate, inflation will work for you. You'll get the benefits of appreciation. You'll get the benefits of principal pay down. All of that is true. But it is also very important, especially if you're in multifamily real estate or commercial real estate and you have those adjustable rate mortgages. It is absolutely imperative to know what's going on with the market, stay on top of interest rates, stay on top of inflation, because if you don't and your rate adjusts to a super high rate that you weren't prepared for, that could be absolutely devastating for your portfolio. And so I am shopping around. I am keeping my eyes on the market. I'm very excited to see what happens in this FOMC meeting next week with Warsh. I am sure that he will keep interest rates the same, but I am keeping my eye on what happens. One other update, just personally, I have diversified some of my money out of real estate this year. So I am in the stock market now. I have about $200,000 in gold mining stocks, because I believe as inflation gets worse, people will move from bonds into gold, and so the price of gold will increase. And when the price of gold increases, traditionally, the price of gold mining stocks increases even more, because now their product is that much more profitable, but they're mining it for the same cost. And so gold mining costs historically, when you see a stagflationary environment, do very well. And so if you're listening to this and you're newer to investing, I don't recommend that you diversify. I don't recommend that you have real estate and precious metals and stocks and bonds. I recommend that you choose one and go all in on it. And obviously, I would choose real estate over anything else. Real estate is the most predictable. Real estate is the best asset class if you don't have money to grow a portfolio, because with the stock market and with precious metals and with actual money to be able to invest in those assets, whereas with real estate, you can use other people's money, you can use leverage to acquire a portfolio. And so if you're starting from nothing, real estate is the best asset class to get into. And what I did is I went all in on real estate until I had a $60 million portfolio, an 8-figure net worth, and then I started to diversify. And I will continue to diversify, right? I'm paying down debt. I have money in the stock market, precious metals. If it ever makes sense, I might have money in bonds, although right now I think that is a horrible investment. I don't think anyone listening to this should have bonds unless you have 30-day T-bills, just to, for your savings, essentially, just to get a little bit of a yield higher than, a savings account. But I diversified when I had a firm foundation in real estate. I had a net worth, I had a track record, and now I'm simply on the defense more than I am the offense. But if you're on the offense, you should not diversify. You should go all in on one asset. You should focus on that one asset. You also shouldn't have multiple businesses. You should have one business. You should focus on that business, and you should do absolutely nothing else. And until that business is profitable, and you can take yourself outside of that business, and if you want to shift from offense to defense, that is the only time that you should diversify. If you study anyone who's created tremendous wealth, none of them diversify in the beginning. They all go all in on one asset class, and then they start to diversify later on. So that is what I'm doing. I have moved, a little bit of money into the stock market. I am very optimistic about it. Although right now, my stocks have not been doing well because the stock market is a little bit ass backwards. So when inflation gets worse, the market thinks that the Fed will fight inflation more and thus increase interest rates, which is bad for precious metals and thus bad for gold mining stocks. And so because inflation has been getting worse, my gold mining stocks have actually been doing the opposite of what I think they should do, and they've been decreasing. So right now, not doing the best, but I think eventually the market will find out that the Fed can't fight inflation, that the, quantitative easing is out of hand, the debt is out of hand. They're not going to be able to fight inflation. They're not going to be able to pay back the debt. And then, when the market finds out that, the Fed is not going to be able to fight inflation, I think I'm going to do very well with that. So it might take 2 years, 3 years, but you shouldn't be investing in the stock market, in my opinion, unless you plan on holding your investments there long term, unless you want to be a trader. or which is speculative, right? But if you want to be an investor, any investment that you make, whether it's in real estate, stock market, precious metals, even cryptocurrencies, which I'm not necessarily a fan of, you should invest that money for the long term, and don't just plan on selling it if it goes up or down. So that's it for today. That is a little update about what I am doing in the market, what I am looking out for, my understanding of the economy, and some other investments that I'm making and how they're doing. Thank you, everyone, for tuning in to the Multifamily Methods Real Estate Podcast, and we will see you on the next one.